Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Direct Digital Holdings, and let me tell you, it's a bit like watching a stock price limbo. Under $1, not fun. But before we get into the nitty-gritty, this report basically says, we got a warning from Nasdaq because our stock price is struggling, and also we sold a bunch of new stock. But don't worry, we're going to break it down. If you enjoy corporate reports explained in simple words, make sure to subscribe. We also have a Discord community linked in the description below. So May of 2025 wasn't a great month for Direct Digital Holdings. They got a notice from Nasdaq, the stock exchange, saying their stock price had been below $1 for 30 days straight. Nasdaq has rules, and one of them is that your stock has to stay above $1 to stay listed on the exchange. Think of it like a report card where failing grades might get you kicked out of the school. This rule is Nasdaq listing rule 55550T, and 2 if you want to get technical. Now they've got about 6 months until November to get their stock price back up above $1 for at least 10 business days in a row. If they manage that, Nasdaq will say all good and the problem is solved. But what if they don't? Well, they might get some extra time if they meet certain conditions, like still having enough publicly traded shares and agreeing to do something like a reverse stock split, which combines existing shares into fewer, more valuable shares to boost the price. If Nasdaq isn't confident they can fix things, or if they don't qualify for extra time, they could get a notice saying their stock is going to be delisted, meaning it would no longer be traded on Nasdaq. For now, their stock is still trading under the symbol DRCT. The company says they're keeping an eye on the stock price and figuring out how to get back in compliance with the Nasdaq rule. If they do get a delisting notice, they can appeal it, but there's no guarantee they'll win. This is not a good place to be. Alright, let's pivot to something else in this report, stock sales. Since May, Direct Digital Holdings sold a bunch of their Class A common stock, around 1,100,000 shares to be exact. They did this in a few days and it brought in around $570,000 after some discounts. Now the reason they're filing this report is because the amount of stock they sold was more than 5% of all their stock outstanding. That's a big chunk. These shares were bought by New Circle Principal Investments LLC under a previous agreement. New Circle had assured the company that they were an accredited investor, meaning they meet certain requirements about income or net worth, allowing them to invest in deals that aren't available to everyone. These stock sales were done without registering them with the Securities and Exchange Commission, relying on some exemptions that allow companies to sell stock to certain investors without going through all the usual paperwork. Now the report includes a section about forward-looking statements. It's basically the company saying, hey, we're making some predictions about the future, but things might not go as planned. They're using words like expect, believe, and anticipate, but they're also warning that actual results could be very different. They point to a bunch of things that could mess things up. These are things they've talked about in their annual and quarterly reports filed with the SEC. These potential issues include everything from the restrictions placed on them by their credit agreements, which are basically loans, to the risk that they might not be able to stay in business, which would make it hard to get more funding. They also mentioned that because they are not eligible to file some short forms, it might be harder to raise money. The Nasdaq warning we mentioned earlier is on this list too. The company lists a bunch of other things that worry them. One is that their business depends on just a few customers, so if they lose those, it hurts. They also worry about clients not paying and about getting a bad reputation if they don't catch advertising fraud. Technology is a worry. If their platform has problems or if they can't keep up with changes, they're in trouble. New rules about tracking people online could make their platform less effective. Also, bad press about the industry or failing to protect data could hurt them. Growing too fast is a problem. If they can't handle the growth, they could stumble. Making acquisitions, which is when a company buys another one, can be tough to manage. New rules about collecting and using data could cause issues. Destination marketing, which are the company's clients, are both public and private entities. If they don't manage that effectively, that could be an issue. Being a public company can put a strain on their resources. Competition in the digital advertising industry is fierce. A data breach, which is a security incident that exposes sensitive, protected, or confidential data, could be really bad. As a holding company, they rely on money from one of their subsidiaries. The people who control that subsidiary might have different goals than the public stockholders. Also, if they don't have fraud, that's a problem. They also point out all the things they already said in their annual report. They finish by saying that if any of these risks actually happen, or if their assumptions are wrong, the future could look very different from what they're predicting. They're not promising anything, and they're not going to update these statements unless they have to by law. They basically say a lot of things could go wrong, and we can't predict everything. This section just lists the exhibits attached to the report, in this case just the cover page in a specific digital format. Now, let's step back and look at the big picture. Direct Digital Holdings is facing some serious challenges. The Nasdaq warning is a major red flag. It suggests that investors aren't confident in the company's prospects, and a delisting could make things even worse. The stock sales, while bringing in some cash, also dilute the value of existing shares. They are selling shares to maintain operations, and that is a vicious cycle that means they need to sell more, devaluing all of the stocks they sell to keep operating. The long list of risk factors is also concerning. It shows that the company is operating in a very uncertain environment and that a lot of things could go wrong. It also shows that management knows the company is on the rocks. On the other hand, the company is trying to address these challenges. They're actively monitoring the stock price and considering ways to regain compliance with Nasdaq rules. They're also selling stock to raise capital and fund their operations. Whether they can successfully navigate these challenges is an open question. It depends on a lot of things, including their ability to improve their financial performance, innovate their technology, and manage their risks effectively. The stock going under $1, the sale of stocks, the generic risk section, all means there are very little positives here. Maybe they need to be selling or restructuring to remain afloat at this point. Alright, that's our breakdown of Direct Digital Holdings' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.